John, Derek, Charles, Billy, everybody happy? We're recording. Okay, so we're now recording, which is great. I'm delighted to welcome you to this week's Pension Playpen Coffee Morning. This week we've got Neil Mains from XPS, who wants to talk to us about what he has learnt recently from the Australian model, and he has already apologised in advance that his knowledge of UK pensions is somewhat limited and a little bit green. And he's only been here back 5 months, I think, Neil. Is that right? You've been back 5 months.
Correct. Yeah.
So there we go. So be kind to him. If there are any awkward questions, then I or Henry will try and help, or some of your more qualified people like John, Billy, or whoever might be able to help with some of the more technical questions. But I think it's a really interesting subject, and I think really looking forward to the presentation. So we are recording. I will open up the chat. If anybody wants to put any questions in the chat or make any points in the chat, please do. There are distinct sections of this presentation, so obviously in typical Playpen fashion, if you want to raise a hand at the end of each section and question Neil or make a point or challenge or praise Neil, then brilliant, absolutely fantastic. So without any further ado, Neil, I'll pass on to you, who I'm sure you'll do a quick introduction of who you are and where'd you come from, a bit like blind date, and over to you.
Thanks, Steve, and thanks everyone for your time this morning and having me. So as Steve has mentioned, I've been I am British, but I've been back in sunny Manchester for about 5 months now. And prior to that, I was lucky enough to live in Sydney, in Australia. I worked for the largest investment consultant in Australia, a company called Jana Investment Advisors, and as part of that role, I was very privileged to advise a lot of the large DC large DC super funds in Australia, and did a bit of consultation work with the Australian policymakers as well. But recently moved back to the UK, as I mentioned, and I'm an investment consultant with XPS. So what I will do is I will share my slides. So just give me a second to get that working. And while I do that, I'll just go through a rough sort of agenda in terms of what I'm proposing to talk through. So actually, first of all, is that clear enough to everyone on the screen? I get a slightly different view, so I just want to make sure it's big enough for you all.
Yeah, looks big enough for me. Is that in full mode, or is that in sort of half mode?
It seems to be full on my.
No, that's fine. That's fine.
Yeah.
I think
It's
if
not in
anybody
slideshow.
can,
It's not in
Yeah.
slideshow mode. It's in that's your screen. You need to go to put it in slideshow and present.
Okay.
All right. Otherwise we'll just see all your notes.
Yeah, which is cheating. Thanks,
So
Barry.
if you click the slideshow, there's it's up at the
Oh no, sorry.
look at slideshow at the bottom next to the slide bar. It's a picture of a screen. No, the other way. Other way to the right. To that one.
Sorry.
Right. That's
Sorry
right.
for this,
No,
everyone.
next
To the
one.
right. That one. Slideshow.
Hit that one.
Slide.
Oh, interesting.
And then
Yeah.
okay.
That's what I thought I did the first time.
You might need to do
maybe I need
live and present in Teams.
2 seconds. It might be the screen that I'm sharing. Just give me a second. I'll try this again.
So much talent on this call. Hey, there we go. Hurrah.
Fantastic. Yeah. Sorry, fantastic start. Anyway, where are we? So in terms of what I wanted to cover. So I think overall, I think the Australian DC system, I think, deserves the merit that it gets as a gold standard system. I think they do a lot of things very well. and I'll touch on I'll touch on some of those things. But I think, like anything, nobody's perfect, and I think there's definitely some things that they've maybe not done quite as well. And I think just human nature means that you talk about your successes more than your drawbacks. But I think actually you can actually learn just as much from things that have maybe not gone so well as maybe things that have gone as well. So this presentation is maybe a little bit more biased towards the things where I think they've had some challenges and areas where we need to make sure that we don't fall down some of the same traps in the UK. So it'll be just 5 minutes at the start, just giving a background on the Australian DC system, because there are some differences to the UK that are important in just understanding why certain policies have got to where they have. And I'll then touch on 4 main areas. So how the Australians have done VFM, private market exposure, consolidation, and then decumulation. Now, as Steve had signposted at the start, I like to think I know quite a bit about the Australian system, and in my 5 months over here, I've been trying to think about how some of the learnings from Australia can be applied to the UK. But there's only so much you can learn in 5 months. I've got some views on how things can be applied, but this is very much a discussion, and therefore heckling it's not only welcome, but it's encouraged. So I'll get started and just provide a bit of a background on the Australian DC system. So first of all, and most of you will know this, DB pensions have been largely phased out now. There's a few public sector schemes that are still running, but the vast majority of people don't have a defined benefit pension. Most people's savings are primarily DC. The coverage in Australia is high. It's in the high 90s. And contribution rates are high as well. So contribution rates are actually written into law, and in the early 90s they started off quite low at a couple of percent, but then over time they've ratcheted up. So at the minute we're at they're 11.5%. And then next year, in July next year, they will go up to 12%, and that's where I think they'll stay. But the high contributions are one reason that there's a high adequacy from the Australian system. Now, really importantly, and really, I guess, differently to the UK, is whilst an employer can recommend a scheme to a member or to a saver, the saver is under no obligation to actually go with that, to go with the employer's recommendation. The employee is free to choose whichever scheme they want to be a member of, and they can ask their employer to direct their contributions to whatever scheme they're a member of. And actually, members can and actually do switch between schemes if they think that they can get a better offering elsewhere. So overall, the engagement and that's one of the main reasons why the engagement is higher in Australia versus the UK anyway. We might talk a little bit about decumulation, in which case it's worth knowing that unlike the UK, the age pension is means tested in Australia, and it's quite a complex calculation, but it's primarily based on the amount of savings that you have, including DC savings. Interestingly, and I think this is important for when we come to talk about policy, is whilst there was a decent amount of bipartisanship when the system was set up in the early 90s, I would say, or the system as I know it today was set up in the early 90s, I would say that like different regimes around the world, there's been a greater polarization of the politics, and that has caused some problems with some of the policy, including, in my opinion, the Australian version of VFM, which I'll come on to in a second. And lastly, from a home bias perspective, and this might have some relevancy to Mansion House, is that there is a home bias in the Australian system, but it does vary by asset class. So there's a big home bias in the listed stock market because there's quite significant tax advantages. But in the private market space, interestingly, there was a home bias at first, but in my opinion, that isn't the case going forward. And lastly, one more just slide just to sort of give you a flavour of what the Australian industry looks like. So it's much more consolidated than we have in the UK. So when I left in April, there was about 60 schemes left. I think there's a couple that have left in the last 5 or 6 months as well. It's roughly split into 4 main types of scheme. So there's industry funds. So these are not-for-profit schemes. They have a trade union heritage. You can start to see where some of the politicization comes from already. And interestingly, many of them have a demographic that they target. So Host Plus, for example, the host is a shortening of hospitality. They target members in the hospitality sector. Care Super, Mind Super. You can see where I'm going with it, and that's been interesting because it's allowed products and services to be tailored to a more homogeneous membership. Retail funds, so profit to shareholder, often a wealth management or a finance background, so heritage. So a lot of the banks have retail funds. There's a few corporate funds left in Australia, but just due to the pressures of consolidation, there's really only a couple left now. And actually, since I put this slide together a few weeks back, Qantas Super have announced that they'll actually be leaving the industry and merging with someone. And sorry, Barry, that question's just popped up. Fund and scheme I'll use interchangeably, but think of it as, I guess, how we'd say provider in the UK. And lastly, public sector funds. So these were set up by either the state or the national government. Interestingly, some of these public sector schemes, they've seen the writing on the wall about consolidation, and they've actually started to take on members from not focusing on the particular industry that they're originally set up for. So overall, very consolidated industry. So I hope that gives you a bit of a flavour of what the Australian industry looks like. Let's start to talk about some of the learnings that I've picked up during my time in Australia.
Neil, just to say that above Barry's comment is another thing about how does the member's choice of scheme work with payroll? Is that quite complicated, or is it very easy at member level to cope with, or?
Yeah, I think it's one of the I guess the benefits of they set up their DC system from scratch, right? And therefore they were able to set up the architecture as they needed to get the type of system that they wanted. So yes, it's very, very easy to switch schemes and have your contributions follow you. I understand it's much more difficult it's more difficult for that to happen in the UK. So let's talk about VFM first. And I think of all the areas that we can talk about today, I think this is probably the area where I have the strongest view, and the view that's, I guess, the most negative of all the things that the Australians have done. I really think, and it's quite a strong statement in that strap line at the top. I think the way that VFM has been changed or has been adopted in Australia has potentially been detrimental to member outcomes. So let me tell you a little bit about where the VFM has come from and why I've got that opinion, and also some of the implications for the UK as well. So the focus on VFM really, the policymaker focus, I should say, really started in 2019, 2020. The Australian policymakers introduced something called member outcomes assessments, similar to what we know as VFM today, I guess pre-consultation. So that was schemes or providers. They determine the metrics that they want to use to assess whether or not they've provided value. They calculate the metrics and they publish the metrics on their own website. That was 2019, 2020. We then went one step further, and the regulator introduced something called the heat maps. So rather than schemes determine the metrics, instead the regulator determines the metrics, and the regulator picked, it was between 20 and 25 metrics across things like investment performance, across fees, etc. And the regulator calculated those metrics, collated them, and released them to the to the public in an Excel document. And if I just skim in my slides, I've got an excerpt from that in the appendix. Yes, it looks something like this. So it's an annual release. So you have all your DC providers down the left-hand side, and then a variety of data provided. And also there was I guess a thought piece that went alongside this from the regulator, calling out providers that they thought were not providing value for members. Now, in my opinion, you can quibble about the metrics, and actually I did quibble about some of the specific metrics, but I would say on the whole, that really drove a laser focus from providers in maximising member outcomes. And if the policy had finished there, I think that would have been a decent position for it to have got to. But really interestingly, the policymakers went one step further, and what they did was, and this was driven by the government rather than, say, the prudential regulator. They picked one of the 20 or so metrics from the heat maps. Again, they calculated that metric for every provider and every product that every provider has, and again released that publicly. But what they did was they implemented very severe penalties for failing that metric. And I'll tell you what the metric is in a second. But if you failed it, you had to, as a provider, write to all your members to say, you are in an underperforming fund. We recommend that you move to a better performing fund. And here's a QR code that you can scan to take you to a list of better performing funds. And if you failed the test 2 years in a row, you were no longer allowed to take on new members. So very, very severe. Now, in terms of what the test was itself, primarily it was performance versus an index-based composite benchmark. So it's over a 10-year time horizon. Now, what all of the providers in Australia have to do is, on a quarterly basis, they have to submit their strategic asset allocation to the regulator. And based on that strategic asset allocation, the regulator determine a customized benchmark for each scheme. So as an example, if you've got 50% in Australian equities and 50% in global equities, your benchmark would be 50% Australian index and a 50% global index. So and that calculation was undertaken over a 10-year time horizon. And again, I've got an excerpt in the back here around what the benchmarks were. So 26 different benchmarks across different asset classes. So in my opinion, and I'll go to see if there's any questions to see if anyone's got similar or dissimilar views to me. In my opinion, this has been very problematic for a few reasons. Now, first of all, I think performance versus an index-based benchmark, I think only covers a very small proportion of what I would determine to be delivering high-quality member outcomes. That's my primary challenge. But you only have to peel back some of the layers to actually think about some of the unintended consequences here. So things like it really incentivizes portfolios to look like benchmarks. Now, what you saw, and it was impossible almost to prove if this test was the sole driver, but you saw moves towards benchmarks, i.e. benchmark hugging, potentially at inopportune times. So addition of duration to portfolios to better match the duration of the benchmarks 4 years ago. Everyone here knows what's happened to interest rates over the past 4 years and what that's likely to have done to performance. It's made allocations to private markets very challenging because by definition, you can't invest passively in a private markets benchmark, and therefore you're going to have some unmanageable tracking error and therefore probability of failing this test from investing in private markets. It makes net zero very difficult as well because none of these benchmarks have any sort of net zero or ESG application to them as well, and it's caused it's really stifled innovation overall in Australia. Now, the reason why I've raised and why I've spent 15 or so minutes talking to everyone here about it is I have seen in the VFM consultation, and I think the UK regulator or the FCA have been careful. They've said We're not going to introduce it now. However, we do note that other regimes like Australia have introduced performance testing versus composite benchmarks, and it's something that we might consider going forward. And my message to everyone here, and I've been giving it to regulators as well, is that this has been a real problem in Australia, and I don't think it would make sense for the UK to go down this route. So at that point, I'll pause and take a couple of questions, because when I've been speaking about this to other stakeholders in the UK industry, it's really generated a lot of discussion.
Yeah, thanks, Neil. Eugen, do you want to unmute Eugen and ask your question, and then we'll come to Derek. Eugen, do you want to go first?
I have actually two questions. One, if financial advisors are involved in choosing the superannuation funds for members who change funds, not the ones that adopt the fund recommended by the employer. And obviously, I ask about benchmark hugging as well, because this will be a clear effect of using benchmarks by the regulator.
Yeah, so in answer to your first question, there is advisors that are used in Australia. I would say they don't get massive use at the minute, and I think the overall role is, I guess, the wider financial planning rather than telling people to switch funds. With regards to your question around benchmark hugging, absolutely, and I think I summed up by saying it stifles innovation. It stifles the I guess the desire to be the best performer and really maximize member outcomes, and therefore I think that's one of the main disadvantages of this. We'll come on to speak about private markets in a second, but in my opinion, private markets have been one of the key or exposure to private markets has been one of the key reasons of the success of the Australian system in generating high quality outcomes for members. And this test makes the allocation of the incremental dollar to private markets quite difficult.
Okay, brilliant. Derek, do you want to just make your point, Derek, as well, or do you want?
I guess my question is, what does the regulator mean by alternatives? It looks more like hedge funds to me than. I mean, I'm thinking alternatives should include private markets, but clearly it doesn't at this stage.
Yeah, you're right, Derek. So I would say private markets have their own categories. I appreciate the writing's quite small here, but there's separate categories for unlisted. There's categories for private market property, infrastructure, and credit. So you're right. Alternatives are primarily hedge funds. Hedge funds have, and I know there's some questions around, how much value hedge funds provide, but in Australia, in DC space, hedge funds have been used as a valuable diversifier, particularly for some of the sequencing risk, which is present towards the end of accumulation options. So, but again, Derek, I can imagine what you're thinking when you see the benchmark to alternatives. It's an equity and bond based benchmark, and therefore it's a real disincentive to actually use alternatives.
Okay, Derek, with that. Yep. Okay. Shay, you've asked a question. Will the slides be available after? Yes, they will. So Neil's confirmed the slides will be available. So yeah, if you want to ask any further questions on that on any point, please raise a hand. But the slides will be available after the session. So yeah, back to you, Neil. Sorry.
Yeah, thanks. So I'll just sum up on the I guess the VFM by saying that we'll see where the UK goes to, but I think Australia are going to unwind this in the next couple of years. There's been a change in government versus the government that brought this in initially. The new government have realised how problematic it is for things like private markets, for things like net zero, and I think this is going to be unwound. And therefore, I think it's important that we don't sleepwalk into something like this in the UK just because we see Australia as Australia's gold standard and something to be copied. So I had one more thing on member outcomes, but just due to time, I want to talk a little bit about private markets as well, both because I think there's there's a real positive that we should look to emulate, and there's some challenges that I really don't think have had enough discussion in the UK that I think it's important that we make sure we don't fall into from a trap perspective. So let's talk about private markets. So overall, Australian DC schemes have significant allocations to private markets. So on average, within default funds, it's about 10% to unlisted infrastructure, about 5 to 6% each in unlisted property and private equity, including venture capital, and a couple of percent in private credit as well. Relatively new asset class. I think the latter will increase a bit over time as well. And I would say for a few reasons that I've said here, I think private markets have been one of the key reasons of why I think the Australian accumulation system in particular has been successful. So there's the return enhancement piece here, and I think it's definitely worth noting that we don't want to fall into the trap of thinking that private markets are just a homogeneous asset class. It's a very diversified asset class with lots of different types of assets with different risk, return, liquidity, fee characteristics, etc. And what the Australians have been good at doing is allocating to some areas of the private market universe that have a higher expected return than, say, listed equities in order to boost expected returns. And for the large majority of history, the selection and the implementation has been high quality, and actually the exposures to private markets have contributed to the high adequacy of the system. But I think the thing that's more important, and this is something that I didn't fully appreciate before I went to Australia, was the diversification benefits of implementing private markets. So interestingly, what you see with, I mentioned right at the start that the Australians are overall more engaged than members in the UK, and during periods of volatility, that can sometimes be a bit of a double-edged sword, because if you have members that are checking their balance on a regular basis, they're seeing that during periods of volatility that their account is falling in value, because remember there's high allocations to equities. They're seeing some of the news flow about the challenge in financial market performance. What you see is the higher engagement working against members, and sometimes people would panic and would de-risk from, say, their default fund to something like cash at the worst possible time, and then miss the subsequent rebound. Where private markets play a role is they're one of the best diversifiers, and there's an argument around whether it's artificial diversification just due to how often they're valued, or whether it's true diversification, but they've been really beneficial in adding diversification to portfolios in Australia and just mitigating against, I guess, that behavioral panic instinct at de-risking at the worst possible time. Now, I think everyone in the UK understands that we need to get we need to get members more engaged, and I think some of that will happen naturally as people's pot size just increase and more people have primarily DC benefits. But what I don't want to see is when we go through a period of volatility, that engagement working as a double-edged sword, and therefore I think there's benefits from that perspective, and sustainability as well. So we can maybe come back onto this, but I think leaning into the energy transition, that's potentially some of the best risk-adjusted returns available. So just in terms of sequencing risk, and apologies, Barry, I should have given an explanation here. So when I say sequencing risk, I mean when you are withdrawing from a portfolio, the order in which you receive returns matters. So if you have negative returns just before you start to draw down from a portfolio, or just as you've started to draw down from a portfolio, versus if you get the negative returns towards the end of drawing down a portfolio, you're likely to run out of money sooner. And therefore, it's really, really important to manage volatility when sequencing risk is biggest, i.e. just at that stage when members are moving from accumulation to decumulation, hence the uncorrelated, really strong diversification benefits of hedge funds and why they're used in Australian portfolios. But back to and hopefully that answered your question, Barry. But just coming back to private markets. So why do I think the Australians have made a success of private markets? So it's for a few reasons. So first of all, they've recognized, as I said at the start of this section on private markets, that they're not a homogeneous asset class, different types of private markets, different characteristics, and they've been very careful with using private markets in the most suitable place. So as an example, if you've got a scheme that's got a younger demographic overall and therefore longer time horizons, maybe a demographic that are on lower wages overall, then there's more of a role, there's more of a time horizon for more aggressive things, private market strategies like private equity. You'll see relatively high use of private equity. They've also been very, very cognizant of the fact that with private markets, there's a large variation in outcomes in terms of if the strategies perform well versus if they don't perform so well, and therefore they've had a laser focus on getting the implementation right. So that's making sure that they choose the best of breed fund managers. And I think the consensus that they've got to is it's not necessarily one fund manager that can do the whole private markets piece. Sometimes you might have to shop around a little bit. And lastly, they've been very careful with the implementation methods. So what they did in Australia, and I think this will happen in the UK as well, is about 10 to 15 years ago, the DC industry took a lot of the talent from the asset management industry and took that in-house. And what that meant was that the capability developed over time as well. So they were more able to do things like co-investments. Even some of the large schemes actually do direct investments and buy and operate private markets themselves. There was a few DC schemes over there that actually clubbed together and actually set up a private markets fund manager. So IFM, who some of you might have heard of, Infrastructure Fund Manager, that was about 20 or so Australian DC schemes coming together and actually setting that up. So they've thought through the way of accessing private markets very carefully. Look, I'm optimistic that we'll get there in the UK as well, but I think it's going to be, if we are going to make a success of the system, it's something that we're really going to have to get right over the next 5 to 10 years. Now, before I talk about some of the the challenges that they've had with private markets, just wondered if there's any questions around some of the good bits.
There are no hands.
Question?
Yeah, go on. Of course, yeah.
Henry here. I'm on the move. Sorry to come and ask a question.
Hi, Henry.
Hi, Neil. Really great stuff. Really interesting. Very, very interesting on the private markets. I want to hear more. But on the VFM question, it always strikes me that the only risk that's being measured in the performance tables is the risk of markets going up and down, and maybe a little bit of manager risk as well if there's some active in there. But primarily, it's about market risk. And yet what members experience, huge amount of risks, including, as you mentioned, sequencing risk, all kinds of operational risk, out of market risk, and so on. And these don't figure in performance tables at all. Has there been any talk in Australia about trying to measure the member experience via using member data, NAVs and contribution histories? Or has it all been about top-down managers producing performance tables and allocations being analysed by regulators, etc.? That's my question.
No, thanks, Henry, and it's a good question, and I would say a lot of the focus is on the the backward-looking performance metrics as you've described. So I should say first of all, by the way, that they do look through a few different lenses. So they'll look at absolute returns, so absolute net returns. They'll look at risk-adjusted returns, which brings in the sequencing risk point, of course. They'll look at performance versus peers. They'll look at performance versus benchmarks. So they do look at it from a few different lenses. But to answer your question directly, what do they do on the member basis? So one thing that I think the Australians do well is they have I think this is starting to come into the UK as well, is they have a cohorting approach. So they don't look at member outcomes in terms of the average member. they consider member outcomes, particularly the outcomes assessments that I mentioned at the start, which was the first pillar, looking at the outcomes from the different cohorts. So young, old, high account balance, low account balance, male, female, etc. And some of the ways that manifests, for example, is in my previous role, I would do a lot of analysis around how a glide path should be constructed. And what you would see, just due to the time horizons involved, is that if you leave the risk on for a little bit longer, or if you glide down to a higher level of risk, then overall for the average member, then that would likely improve their returns through a lot of lenses. Through some, like risk of, I guess, the really severe downside outcomes, no, but overall, yes. But when you start to bring in a cohort approach to things, I think that changes the question a little bit, because there'll be some demographics of the membership, particularly for those who are currently at the back end of the glide path, where that isn't suitable for. And therefore, what they do really well in Australia is, before they make changes, they consider what the impacts are on the different cohorts and making sure that they're trying to improve the outcomes for every cohort. So let me give you I guess a solid example of how I think that's manifested in a decent way. There's just one that do it at the minute, out of the sort of 57 or 58 schemes that are left, is once you reach the point in the accumulation phase at which you start to de-risk, what they will do is they will look at your balance. And if your balance is above a certain level, i.e. a level where you're expected to get to high quality outcomes, be it some sort of standard like the PLSA, or be it an income replacement ratio, if you're projected to get to there, they will de-risk you on a path where you'll de-risk to a level of risk that they still think you can achieve those objectives. Whereas, and this is the benefit of the cohort approach, whereas if they don't think that you will get there because your balance is too low, they will keep risk on for longer in order to, I guess, maximize the likelihood that you've got the time horizon, you've got the growth exposure to make up that difference. So long-winded answer, Henry, but I think it's a bit of both. There is a focus on backward-looking market benchmarks, but the size, the scale, the talent in the industry means that there is this move to this cohort approach.
Sounds very odd to me. Thank you.
Excellent. So I'm running out, and this always happens, by the way. I've really enjoyed speaking to different people around the industry, and I've always
doing well.
loved. So let's talk about some of the I guess the challenges that they've had with private markets, because these challenges are not insurmountable, by the way. I definitely think the UK is able to manage these, but I think they need to be considered and addressed before private market exposures are built out in the UK. So let me start by saying something that always made me smile was that the Australians refer to themselves as the lucky country. And there's a few reasons for that. So it's in a place where there's good weather, so they get you've got food security. It's in the middle of nowhere as well, and that means that they've been isolated from a lot of the wars that have gone on in the past. Abundance of natural resources, so they've got the best quality iron ore that China will take anything that they can produce. And what that's meant is that they've had a solid period of economic growth, financial market performance for decades now. That's all very well and good, but what that meant, and this is only for this isn't broad brush across the entire industry. The regulator have been very clear that this is only for some of the providers. Is the good times allowed some, let's say, shall we say, not so good standards of investment governance to slip in. And they were really exposed during COVID, which was something that, despite Australia being the other side of the world, they weren't able to avoid. And Australia was hit quite bad by COVID. And a lot of these challenges were in the private markets space. So let me talk you through two of the main ones around inadequacy and liquidity management, and also some challenges around treating members fairly. So let's do liquidity management first of all. So I'm speaking to a group of knowledgeable people here. You'll all be aware that DC investors have some of the longest time horizons and therefore the biggest capacity to take liquidity, invest in private market assets. But what happened in Australia during COVID was, and this took the industry by surprise, was that the Australian government let DC savers withdraw up to $20,000 from their savings as long as they could show that they were suffering financial hardship, and the bar to demonstrate that they were suffering financial hardship was quite low, i.e. a lot of people use this this flexibility. And what you saw was that, again, I want to emphasize, it was some providers only, not all providers. This showed that some entities didn't have high quality liquidity management plans in place. So there was nothing around, if we need to suddenly raise liquidity, what order will we go about it, who's responsible for it, etc. And there were some instances apparently where things were being fire sold. And I think short-term liquidity needs from DC portfolios, I think, is going to become something that's going to become more of a thing going forward. So the government that is now in opposition, actually, one of their main tenets for getting back into power, one of their main election pledges, is that people can have access to their DC savings in order to fund the deposit for a first house purchase. And I see similar things being discussed in the UK around it's going to be one of the only ways that we can get adequacy and contributions up is if we provide some flexibility to access savings before people retire. And therefore, having high quality liquidity management plans in place, I think, is a must. Now, I don't think the UK will be caught out as much as some entities were in Australia because of the learnings from the gilts crisis. I think having high quality plans in place, I think, is fresh of mind. But I think we need to make sure that the knowledge that, I guess, our DB stakeholders have got very much front of mind, that's translated across to the DC industry as well. So things like stress testing on portfolios to see at what point a liquidity would become a problem for the scheme, and making sure that there's a plan in place to make sure that we don't actually get to that point, and getting that in place before the allocations to private markets are built. Secondly, and this is a really interesting one, issues around treating members fairly. So like the UK, in Australia, members have some flexibility with regards to switching their savings within a DC plan, and also to taking out their savings when they come to retire. So as an example, in Australia, if you wanted to come out of the default fund and go into another into a self-select fund, in theory, you have daily liquidity. You can trade on a short-term basis. Now, when you have that type of system, and when you're using a large proportion of private markets in your portfolio, that can introduce some challenges around treating members fairly. And again, it was COVID that really shone the spotlight a spotlight on this, and shone the spotlight on entities where there maybe weren't high quality plans in place. But let's think about what happened during COVID. So you had equity markets for one period of time fell quite significantly, quite aggressively. So the stock markets were down about 20%. And what you had is you had 25 to 30% of portfolios that were being held at artificially high values because they're only valued on an infrequent basis, let's say monthly, quarterly, in some cases annually. So you had stale valuation risk effectively. And you had members who were able to, be it contributions that were being paid in, be it benefits that were being taken, you effectively had members that were trading at incorrect prices. And the reason why I think this is really important for the UK is, and to make sure we don't fall down some of these or encounter some of these same challenges, is the stale valuation risk is present when there's larger allocations to private market assets, obviously, and I think that's where policymakers, and I think that's where providers will end up getting to, but particularly when you use private market asset classes that are less frequently valued, i.e. private equity, mansion house. You see where I'm going with this, and therefore I really think it's important that, again, before these allocations are implemented, that the UK schemes have policies and procedures in place for how you manage stale valuation risk. Now, I did a little bit of I did quite a bit of work with different providers in Australia and some policymakers as well. Now, where I got to with this, and it might be different when you bring it back to the UK, but where I got to with this is a good quality policy would have triggers in place for when stale valuation risk is present. So that might be something like a big fall in markets, and then you would have some sort of procedure in place that would convene, be it people from the investment committee, from the trustee board, and with experts who've got a lot of knowledge about private markets, and it would convene a meeting where you would work out, okay, how do we best deal with this? Because I think every situation will be different, and therefore you won't have one solution that will work in all cases. So you might have things like, do you freeze trading in the fund? It's an extreme outcome, but if you've got big market moves, you might have to do it. Do you change the transaction costs on the funds to dissuade people from trading? Do you actually go to your private markets fund manager and say, we know you've only got a valuation in 3 months' time, but actually we've got some stale valuation risk here. Can we commission an independent valuation in the meantime? I think there's a variety of different ways of dealing with it, but I think it's important that there is policies in place to deal with it. And the same goes for performance fees as well. So I think performance fees will, in terms of presenting member equity or member fairness risk, I think we're going to see more and more performance fees within DC portfolios. I have a strong opinion that if you use private equity, private markets in general, I think it makes sense to have performance fees. But because they're only calculated on a discrete basis, i.e., when the private market asset is disposed of, i.e., is sold, you have issues around how do you make sure that you're treating your members fairly. And again, it's all about getting these policies in place before you start to run into issues, I think is the key thing. And I see, hi John, you've got your hand raised.
Yes, I put something in the chat. Private markets in the UK for DCs are restricted in the main by concepts such as professional or sophisticated investors only. So how do you get the excess returns that we can actually produce with some intelligence on investing? How do we get those to the retail investors? Because the regulator, my experience of just 50 years of advising, was that a client was a sophisticated investor when he was making a profit, and changed to being a retail investor when he'd lost money. So there's a need to protect the advisor against variable clarifications by investors. So this where the money's needed.
Yeah, so look, this will be where the UK knowledge becomes a little bit limited. So my understanding of where this is getting into UK portfolios at the minute is a lot of the big providers are currently considering private market exposure. I know one of them has already come out and made one, and I think the majority of the rest of them are currently considering how they build it, and they'll come out with something within the next 6 to 12 months. It's the big end of town. I think the smaller own trust schemes, it's harder to get private markets in there, but there's definitely ways that it can be done, particularly via some of the investment platforms that a lot of them use, where because of the ability of platforms to benefit from scale and aggregate exposures from different investors, I think it's possible for own trusts, even small own trust schemes, to get access to private markets. And I know Henry's had some discussions with a solution that my own firm XPS has built that helps in that space. So I think from a sort of coverage of the population, I think that will allow private markets to get into the portfolios of, I guess, a decent proportion of the UK membership. John, are you talking about something sort of different in terms of members that aren't captured by that part of the system? In which case, the UK sort of infancy is a bit of a sort of capacity on my ability to respond.
Okay, well, I was doing private markets 30 years ago,
yeah.
and and did a lot 20 years ago. In fact, I've still got 2 still running, even though I've retired, because I'm the only one who seems to remember how we did it. But it's not the big funds that actually mattered, you know. It's they will finish up with Macquarie, and then they'll buy, I don't know, Thames Water and benefit their institutional investors. Those things seldom get down to the retail customer. But then when you get down to the retail customer in the UK, you can't actually propose such things to people who are not self-declared or their accountants haven't declared that they're sophisticated investors who can take the risk. So it's sort of self-defeating. The regulation doesn't allow you as an advisor to actually push these products forward. You know, we've got RPI plus returns guaranteed, and were AAA rated when put in place. There were 30-year deals.
Yep.
We now have an issue where we need a secondary market to create the liquidity for those people who are now over 75, or those people who suffer from LTA problems, and they may come back. We need a secondary market there. So that's what we're exploring. But it's very difficult to stay compliant with the regulator or not put yourself at personal enormous risk of bankruptcy on some of these things for trivial rewards. So the business case for the advisor just doesn't make sense anymore. You know, why would you actually take something with modest fees and actually underwrite the whole damn performance over a 30-year period? Because that's effectively what you're doing. No business case, nobody in their right mind would go into that business.
Yeah. Look, I take the point, John. I guess, and I'll accept everything that you've said, and thanks for the explanation. I guess the only thing that I can say is, in terms of my role in Australia, it was advising the DC super funds, which the majority of the population were in, and therefore they got the benefits of private markets. And in the UK, the company that I work for, XPS, so our role in the DC space is working with and advising master trusts and also own trust schemes as well. And therefore, it's just not my experience to sort of go more into the retail space. So
No, don't get me wrong. I'm with you. I think what you're doing is absolutely the right thing that should have been done years ago. The trouble is, if you try to be too entrepreneurial, the regulations is a bit of an uphill fight. Yeah. But no, I think what you're doing is absolutely correct, because not everybody can be above average, which is what everybody wants to do.
Yeah.
In determining value for money, you've got to be the right side of the curve, haven't you? Right side of, and of course somebody has to be there to make the top half possible.
Yeah. But look, I come back to something that the Australians did. And I know I've already mentioned this, but something they recognised earlier on was that the variation in outcomes from private markets is wider, and therefore it's not something that you can sort of do with just a couple of a very small investment team. So the Australians, they built up the capability within the schemes over time, and there was a real focus on best of breed exposures to private markets. Because what I think wouldn't be a good outcome is, let's say Mansion House is implemented. Let's say if private markets exposures do look something a bit more like Australia. What would be a real shame is if the exposures have been rushed and if the returns are not particularly strong, because that would just completely stop any sort of momentum. But I'm confident, just based on the discussions that I've had with the industry. I think people are looking at what's happened in Australia, and I think they'll learn the lessons for why things have gone well and why things haven't gone so well.
Okay, thank you.
I just want to touch on one final thing quickly around consolidation, and I will rush. So I think overall, consolidation has been overwhelmingly positive for Australian schemes and Australian members. It's kept costs down, and just going back to the private markets thing, it's allowed capability to be brought internally within schemes, and I think that's really supported high quality investment strategies, high quality returns. But in my opinion, the first signs of diseconomies of scale were just starting to appear. Now, why I think this is important for the UK is, to go back to the slide that I had at the start, is Australia's consolidating into a much larger number of providers than I think the UK is going towards. I think Australia will end up at something between 40 and 50. And if the diseconomies of scale are starting to appear at that number, there's some implications for the for the UK. So what do I mean in terms of why I think they're starting? So things like the Australian schemes are so large that it can actually present liquidity issues when they're actually trying to buy and sell assets. So Australian schemes have been long-term investors in the domestic stock market, tax incentives, etc. But the Australian DC industry is now bigger than the Australian stock market. And that means that when they're actually trying to trade in and out of domestic stocks, it can actually be hard to find the liquidity. I've made a point about being less agile as well. So size brings you scale. You can negotiate fee discounts. You can bring the talent in, etc. But what I think the industry were just starting to find was, and this particularly relates to the energy transition, is that a lot of the investment opportunities around the energy transition, particularly the earlier stage things, so actually like building a wind turbine or whatever the asset is, the fund managers that are raising capital here, they're raising relatively small amounts. So it might be 500 million, it still sounds big in absolute terms, but 500 million Australian dollars. Now, what that means is if you're a scheme, like the biggest scheme in Australia now is 250 billion. If you've got 250 billion to deploy and fund managers are only raising 500 million, then you're either going to have to be large proportions of private equity infrastructure vehicles, and these managers aren't going to like that because it presents a business risk if your investor base is concentrated just in one investor, or you're going to have lots of small allocations, i.e. the governance starts to get a bit tough, you start to become less agile, and I think that comes when you just start to get too big. And the emergence of silos as well. Look, I didn't see widespread evidence of this, but particularly towards the end of my time in Australia, as the providers got bigger, you just found decision making just started to slow down. There was maybe one too many committees that things had to flow through. So when you bring all of this together, I just feel like that the Australians were just on that tipping point of going from economies of scale into diseconomies of scale. And I think it's really important the UK providers are aware of this and have plans in place for, okay, we might be 5 billion at the minute, but how does our whole business model look when we're 50 billion rather than 5 billion? Because I've just shown, just from investment reasons alone, the decision making process changes considerably. And I think the UK providers will get to that 30, 50 billion a lot sooner than maybe some in the industry think. So just a thought to leave you with, because I appreciate we've hit the half hour.
Yeah, it's really great presentation, Neil. And obviously there's an AI bot. I think, John, you put an AI bot in here about a summary of the takeaways for the meeting. So thanks for that, John, as well.
Well, don't thank me for that. My son did that to me. I don't know how to turn the damn thing off.
So there you go. So there's an otter.ai bot that's given a full summary of what Neil's been saying. But if anybody would like the slides, then please email myself or Henry Tapper, and we will send those off to you. And Neil, that was a fantastic presentation. Are there any other questions before we sort of wrap up? I think looking at the...
Yeah, one question for me, Neil, is are these slides okay for me to post generally, or have you yet to get that from your compliance department?
So compliance have said it's okay, Henry. If you could let me send you a slightly amended copy. There was a couple of spelling mistakes from the initial version that I sent you, so I'll get them across to you today.
Fantastic.
Let me be so perfectly the enemy of truth, Neil. That was a really great presentation.
Really good. So
I'm going to be spreading it around the market. I can tell you.
Can I just say,
okay.
Can I just say one thing? I've just noticed that we're in contact with Andre at your firm about one of the concepts that we put together for you. So we're just waiting for NDAs to be signed.
Oh, there you go.
Look forward to speaking soon.
Joining the dots, John. Joining the dots. Brilliant. There you go.
Andre is the boss. So yes, I'm sure. Yeah.
There you go.
Challenging.
Indeed. Thanks, everyone. It's great to meet you.
Cheers.
Yeah, Neil, thanks for that. You know, and the video of today and the podcast will be up later on this afternoon. Next week we have
this AI bot. John, can you send the AI bot to me as well? Because I'd like to use that to transcribe the presentation.
Yeah, John's son will do that probably, but you know,
well,
if John's son can help.
Yeah, okay.
Yeah.
Thanks very much. Cheers.
Next week we have a really good in conversation with Terry Pullinger, who some of you may know was very heavily involved with CDC. And as you've seen in the news in the last few weeks, first UK CDC scheme's been launched. So that should be a really good session on CDC and the first scheme in the UK. Neil, one for you to maybe attend, you know, so
absolutely
watch out.
Indeed.
So, but I'm sure you'll all join me in thanking Neil for his presentation today. And we wish you, you know, a good rest of the day, good rest of the week. And as usual, we pray for peace in the East and peace in the Middle East. So, you know, we really appreciate everybody's questions and input. And a special thanks to you, Neil, for your fantastic presentation. So thanks very much indeed. So,
thanks, everyone.
Yep, that's great. And Chris Clark wants you to go back about decumulation. So there you go.
Fantastic. My pleasure.
Lots to do. Brilliant. All right. Thanks, everyone. Enjoy the rest of your day. Cheers. Bye. Bye.
Thank you.